What do you think about how car prices have been over the last few years?
They're astronomical, but I mean, the technology keeps advancing. Technology isn't free.
I shopped around quite a bit. Before I was driving the Toyota Highlander, and the prices had went up a lot. So I went with the Tesla.
Oh my goodness. I was trying to repurchase a Camry and using the prices that I had from 10 years ago, and it just wasn't, it wasn't the same.
America's car market is spiraling into chaos. Dealership lots are overflowing, prices are through the roof, and automakers are watching their profits vanish faster than ever. Automakers thought they could charge whatever they wanted, but the bubble is bursting. Inventory is stacking up, prices aren't dropping fast enough, and the industry is hurtling toward a reset that could change everything. But how did car prices get so out of control? And why are dealerships refusing shipments? What will happen to automakers as profits collapse and layoffs begin? Most importantly, how does this all affect you? Because what comes next for the auto market is much worse than you expected. What's happening? Car prices in America have skyrocketed over the past 5 years, and consumers are finally saying enough is enough. What used to be a manageable expense has now become a luxury few can afford. Walk into a dealership and you're greeted with sticker prices north of $50,000 for trucks and SUVs that used to sell for half that. The average transaction price for a new car today is hovering around $47,000, an amount most Americans simply can't justify. Dealerships are now drowning in inventory, with over 3 million new vehicles sitting unsold, the highest level in 4 years. But here's the twist, even though inventory levels are rising, it's not the cars people actually want. Affordable models priced under $30,000 are practically extinct, while high-priced trucks and SUVs dominate the lots. At the heart of this crisis lies a major disconnect. Automakers have focused on premium, high-margin vehicles, leaving everyday buyers out in the cold. This strategy worked during the pandemic, when supply chain issues kept inventory low and demand high, but now the tables have turned. Supply has returned, but demand, it's nowhere to be found. Why is the car market bursting? It all comes down to a mix of miscalculation, greed, and changing priorities. Automakers shifted their focus to higher-end models, thinking consumers would continue to pay premium prices indefinitely. The logic was simple. Fewer vehicles sold at higher prices would yield the same or better profits. And for a while, it worked. But this strategy wasn't built to last. Rising interest rates have pushed monthly car payments into uncharted territory. Today, the average monthly payment for a new car is over $700, making ownership unaffordable for a vast majority of Americans. Pair this with inflation and stagnant wages, and it's no wonder buyers are turning away. Then there's the electric vehicle gamble. Automakers poured billions into EV development, betting big on a rapid shift to electric. However, the transition hasn't been as smooth as expected. EVs are selling, but not at the pace automakers anticipated. They overproduced expensive models and underproduced affordable ones, leaving a glut of high-priced vehicles sitting unsold. Dealerships too are feeling the heat. For years, they've been begging automakers to produce more affordable cars, but their pleas have largely fallen on deaf ears. Now, many dealerships are outright refusing shipments of overpriced inventory, knowing they can't sell these cars without massive incentives. Signs of a market collapse. The cracks in the market are becoming impossible to ignore. Automakers like Nissan, Ford, and Stellantis are seeing their profits plummet. Nissan, for example, reported a staggering 99% drop in operating profit for a single quarter. Yes, you heard that right, 99%, and they're not alone. Ford's stock recently experienced its worst day since the global financial crisis, and Stellantis dealers are openly voicing their frustrations over unsold inventory. Incentives, once an afterthought, are now the automaker's primary weapon to move vehicles. According to J.D. Power, year-over-year incentive spending has increased by 53%, but here's the kicker. Even with these discounts, prices are still too high for many buyers. Incentives help, but they're not enough to offset the underlying affordability crisis. Consumers are fighting back. They're walking away from new car purchases altogether, opting instead for used cars or holding onto their current vehicles longer. And who can blame them? With interest rates nearing 10% and limited affordable options, the math simply doesn't add up. The result, dealerships are stuck with hundreds of days worth of inventory, far more than the healthy 90-day supply they aim for. So what are automakers doing to fix this mess? Unfortunately, not enough. While some have increased incentives, most haven't taken the crucial step of lowering MSRPs across the board. Instead, they continue to produce expensive models, hoping consumers will eventually bite. History, however, suggests a different approach might work better. Take Acura, for instance. In 1999, they released an updated model of the 3.2 TL and lowered its price by $5,000 while adding more features. The result? It became a bestseller, moving at MSRP for nearly 2 years. Consumers saw value and they responded. Automakers today could take a page from that playbook, but so far, few seem willing to make such bold moves. Meanwhile, dealerships are left to clean up the mess. They're offering steep discounts and financing deals just to clear their lots, but these efforts can only go so far without support from the manufacturers. The result? A growing divide between automakers and their retail partners, with each side pointing fingers at the other. As we move forward, the big question is whether automakers will finally address the root of the problem: affordability. If they don't, the crisis will only deepen, and the ripple effects will be felt far beyond the showroom floor. The shift to premium models. For the last several years, automakers have followed a strategy that on the surface seemed bulletproof. Focus on premium vehicles. Higher price tags meant higher profit margins, and fewer units needed to be sold to maintain profitability. It was a calculated gamble, but one that failed to account for changing economic realities. Now, this shift is at the heart of the affordability crisis gripping the automotive industry. During the pandemic, supply chain issues drove up demand for new cars as inventory became scarce. Automakers capitalized on the situation, raising prices across their lineups. A $50,000 truck or an $80,000 sport utility vehicle became the norm, as buyers who needed vehicles had little choice but to pay these inflated prices. For a time, the strategy worked. Automakers posted record profits, and dealerships thrived on the higher transaction prices. But this golden age was short-lived. Supply chain problems eased, and inventory levels began returning to normal. Suddenly, the premium pricing strategy started to crack. Buyers no longer felt compelled to pay top dollar, and many walked away from the market entirely. Automakers found themselves stuck with lots full of vehicles that few could afford, and their once profitable strategy quickly became a liability. Consumer pushback. The reaction from consumers has been swift and severe. In the past, automakers could rely on brand loyalty to keep customers coming back, but loyalty has its limits. When prices climb beyond reach, even the most dedicated customers start to look elsewhere, or simply stop looking altogether. Today, the average new car payment has soared above $700 per month, a figure that was unthinkable just a few years ago. Rising interest rates have made financing even more expensive, pushing the cost of vehicle ownership further out of reach for many households. Faced with these daunting numbers, consumers have begun to question the value of buying new cars at all. For many, the used car market has become a haven. Vehicles with a few years of wear now offer significantly better value, especially as automakers continue to price themselves out of reach for the average buyer. Others are simply holding on to their existing vehicles longer, delaying purchases in the hope that prices will eventually come down. This shift in consumer behavior isn't just about affordability, it's also about priorities. Over the last decade, automakers have emphasized technology-packed high-end models. Features like advanced driver assistance systems, touchscreen interfaces, and luxury interiors have become standard in many vehicles, but these extras come at a cost. While some buyers appreciate these enhancements, others see them as unnecessary and would gladly trade them for a lower price point. The role of electric vehicles in the crisis. Electric vehicles, once hailed as the future of transportation, have added another layer of complexity to the affordability crisis. Automakers have invested billions of dollars into electric vehicle development, pouring resources into battery technology, charging infrastructure, and production facilities. These investments have driven up costs across the board, even for traditional internal combustion engine vehicles, as automakers scramble to fund their transition to electric. The problem is that the demand for electric vehicles has not kept pace with these investments. While electric vehicle sales have grown, they remain a small fraction of total vehicle sales. Many electric vehicles carry high price tags, often starting at $50,000 or more, making them inaccessible to a majority of buyers. Incentives like government tax credits have helped bridge the gap, but these subsidies are not permanent. As they begin to phase out, the cost of electric vehicles will become an even greater barrier. In the meantime, automakers have scaled back their electric vehicle projections. Initial plans to electrify entire fleets within a decade are being reconsidered as companies companies grapple with sluggish sales and unsold inventory. But the damage has already been done. Billions of dollars have been sunk into electric vehicle development, and automakers are now struggling to balance their aspirations with financial realities. Dealerships caught in the crossfire. While automakers bear much of the responsibility for the affordability crisis, dealerships are the ones feeling its immediate effects. For years, dealerships have served as the front lines of the automotive market, managing inventory, negotiating sales, and maintaining relationships with customers. But their role has become increasingly challenging as the disconnect between manufacturers and buyers widen. One of the biggest frustrations for dealerships has been the overproduction of expensive vehicles. Dealerships have repeatedly called on automakers to produce more affordable cars, only to see their lots fill up with trucks and sport utility vehicles priced at $50,000 or more. With buyers unwilling or unable to pay these prices, dealerships are left holding the bag. This has led to a growing standoff between dealerships and manufacturers. In some cases, dealerships are refusing to accept new shipments of overpriced inventory, knowing they cannot move these vehicles without significant incentives. This in turn creates friction with automakers, who rely on dealerships to clear inventory and keep production lines running. The situation is further complicated by the rise of online car buying platforms. These platforms, which allow buyers to search inventory and complete transactions from the comfort of their homes, have disrupted traditional dealership operations. While they offer convenience for consumers, they also put pressure on dealerships to compete on price, further eroding their profit margins. Overproduction and the inventory glut. At the core of the affordability crisis is a fundamental mismatch between supply and demand. For years, automakers have focused on producing high-margin vehicles, banking on the idea that fewer sales at higher prices would yield greater profits. But this strategy has backfired as economic conditions have shifted. Today, dealership lots are overflowing with inventory. Over 3 million new vehicles are sitting unsold across the United States, the highest level in 4 years. While this might sound like good news for buyers, there's a catch. Most of this inventory consists of expensive trucks and sport utility vehicles, not the affordable models that many consumers are looking for. This imbalance has created a vicious cycle. Automakers are ramping up incentives to move unsold inventory, but these discounts are not enough to make a dent in the affordability crisis. At the same time, dealerships are growing increasingly frustrated with manufacturers, as the glut of inventory makes it harder to meet sales targets and turn a profit. The situation is particularly dire for some brands. Nissan, for example, has reported a 99% drop in operating profit for a single quarter, driven largely by its inability to move unsold vehicles. Stellantis dealers, meanwhile, have been vocal about their struggles to clear inventory, with many calling for more aggressive action from corporate leadership. Lessons from the past. History provides some valuable lessons for automakers as they navigate this crisis. One of the most notable examples comes from Acura in the late 1990s. When the company introduced the updated 3.2 TL in 1999, they made a bold move. They lowered the price by $5,000 while adding additional features. The result was a bestseller that moved at the manufacturer's suggested retail price for nearly 2 years. This strategy worked because it aligned with what consumers wanted: value. By offering a compelling combination of price and features, Acura was able to attract buyers and maintain profitability. Today's automakers would do well to follow this example, but so far few seem willing to make such a bold move. Instead, many are doubling down on their current strategies, hoping that incentives and marketing will be enough to move inventory. But without meaningful price reductions, these efforts are unlikely to succeed. Consumers have made it clear that they are unwilling to pay inflated prices, and automakers must adapt if they hope to win back their trust. The growing divide. The gap between what automakers are producing and what buyers can afford has never been wider. While manufacturers continue to focus on premium models, consumers are demanding more affordable options. This disconnect is not just a temporary problem, it is a structural issue that threatens the long-term health of the industry. One of the most striking examples of this divide is the pricing of compact sport utility vehicles. These vehicles, which were once considered affordable, now often start at over $30,000. Even with incentives, the average transaction price remains out of reach for many buyers. This has forced consumers to look elsewhere, with some turning to used cars and others delaying purchases altogether. At the same time, the high cost of new vehicles is putting additional pressure on households. Rising interest rates have pushed monthly payments to record highs, while inflation has eroded purchasing power. For many families, buying a new car is no longer a realistic option, and this shift is reshaping the automotive landscape in profound ways. The path forward. The automotive industry is at a crossroads. To regain the trust of consumers, automakers must make affordability a priority. This means more than just offering incentives. It requires a fundamental shift in strategy, lowering the manufacturer's suggested retail price on new vehicles, producing more affordable models, and balancing the transition to electric vehicles with the needs of everyday buyers are all critical steps. Dealerships too have a role to play by advocating for the interests of their customers and pushing back against manufacturers when necessary. They can help bridge the gap between automakers and buyers. At the same time, they must adapt to the changing landscape of online sales and find new ways to compete in an increasingly digital marketplace. Policymakers have an opportunity to support the industry by incentivizing the production of affordable vehicles. Tax credits and subsidies for lower-cost models could help bring prices down and make car ownership more accessible to a wider range of consumers. The challenges are significant, but so are the opportunities. By prioritizing affordability and value, the automotive industry can not only weather this crisis but emerge stronger and more resilient than before. How are consumers feeling the pinch? For millions of Americans, owning a car is no longer a matter of convenience, but one of financial survival. Yet, as the affordability crisis worsens, this basic necessity is slipping further out of reach. The numbers paint a grim picture. The average transaction price of a new vehicle hovers near $47,000, while the average monthly car payment has surged to over $700. With rising interest rates pushing loan costs even higher, car ownership is becoming a luxury reserved for the few. Consumers are not just struggling to afford new cars, they are actively resisting the market altogether. Many have shifted their focus to used cars, which often provide better value for their money. Others are choosing to delay vehicle purchases entirely, opting instead to repair and maintain their current cars for as long as possible. This shift is reshaping the automotive landscape, forcing automakers and dealerships to confront a new reality. The customer is no longer willing to pay inflated prices. The gap between what consumers want and what automakers are offering is staggering. Surveys consistently show that buyers are looking for affordable vehicles priced under $30,000. Yet these models are virtually non-existent in today's market. Instead, dealership lots are filled with high-margin trucks and sport utility vehicles priced well above $50,000. For many buyers, the math simply does not add up. Why are automakers struggling? The affordability crisis is not just hurting consumers, it is wreaking havoc on automakers as well. Major companies like Ford, Nissan, and Stellantis are facing unprecedented financial challenges as their profits plummet. Nissan, for instance, recently reported a 99% drop in operating profit for a single quarter. To put that into perspective, a company that once generated billions in revenue is now barely breaking even. At the root of this struggle is the disconnect between production and demand. Automakers have spent years focusing on high-margin vehicles, banking on the idea that consumers would continue to pay premium prices. But as economic conditions shift, this strategy is proving unsustainable. Buyers are no longer willing to pay top dollar for new cars, and dealerships are struggling to move inventory as a result. The problem is compounded by the rising cost of production. The push toward electric vehicles has required significant investments in research, development, and manufacturing. While these investments are necessary for long-term growth, they have also driven up the price of both electric and traditional internal combustion engine vehicles. Automakers now find themselves caught in a vicious cycle. They need to sell high-margin vehicles to recoup their costs, but those very vehicles are the ones buyers are least likely to purchase. The ripple effects on the economy. The fallout from the affordability crisis extends far beyond the automotive industry. As new car sales decline, the effects are being felt across a range of industries that depend on a healthy car market. From insurance companies to auto repair shops, businesses are grappling with the economic ripple effects of declining car sales and rising prices. For dealerships, the challenges are immediate and tangible. Unsold inventory is piling up, forcing dealerships to offer steep discounts and incentives just to stay afloat. Many are turning to creative financing options such as 0% interest loans to attract buyers. But these measures come at a cost, eroding profit margins and straining relationships with manufacturers. The impact is also being felt on the manufacturing side. Automakers are scaling back production to avoid further inventory buildup, leading to layoffs and reduced hours at factories across the country. Jeep, for example, recently announced the layoff of over 1,000 workers responsible for producing the Gladiator truck, a direct result of sluggish sales and bloated inventory levels. These job losses are not just numbers on a spreadsheet, they represent real people and families affected by the industry's struggles. The effects extend to the used car market as well. While demand for used vehicles remains strong, the affordability crisis is driving up prices in this segment as well. Buyers who would have purchased new cars are now competing for used models, creating additional strain on the market and driving up costs for everyone involved. What now? As the automotive market grapples with its affordability crisis, one thing is clear: change is inevitable. The question is not whether the market will reset, but how and when. One of the most immediate changes is the rise in incentives. Automakers are ramping up discounts and promotional offers in an effort to move unsold inventory. According to industry reports, incentive spending now accounts for nearly 8% of the average vehicle transaction price, a significant increase from just a few years ago. While these incentives are helping to bring prices down, they are also putting additional financial strain on automakers. But incentives alone are not enough. To truly address the affordability crisis, automakers must take more drastic action. Lowering the manufacturer's suggested retail price on new vehicles would be a bold move, but one that could help restore consumer confidence and drive sales. History has shown that price reductions, when paired with value-driven features, can be highly effective in attracting buyers. However, most manufacturers remain hesitant to take this step, fearing it could erode their profit margins in the short term. The transition to electric vehicles also presents a unique challenge. While the long-term goal of electrification remains critical for the industry, the short-term focus must shift to balancing electric vehicle production with the needs of everyday buyers. This means producing more affordable electric vehicle options and ensuring that traditional internal combustion engine vehicles remain accessible to a broad range of consumers. For dealerships, the path forward involves adapting to a changing market. This includes embracing digital tools and platforms to attract a new generation of buyers, as well as working closely with manufacturers to advocate for more affordable models. By aligning their interests with those of their customers, dealerships can play a key role in shaping the future of the automotive industry. The role of government and policy cannot be overlooked. Policymakers have a unique opportunity to support the industry by incentivizing the production of affordable vehicles. Tax credits, subsidies, and other measures aimed at reducing the cost of entry-level models could help bridge the gap between consumers and automakers, creating a more sustainable market for all stakeholders. The success of the market reset depends on the willingness of all parties to adapt. From automakers and dealerships to consumers and policymakers, each has a role to play in addressing the affordability crisis and ensuring a more stable future for the automotive industry. The future of car ownership in America. The current crisis is a wake-up call for the automotive industry, but it also raises important questions about the future of car ownership in America. As prices continue to climb and economic conditions shift, traditional notions of car ownership are being challenged. New models such as subscription services and shared mobility options are gaining traction as consumers look for alternatives to outright vehicle ownership. At the same time, the rise of technology and digital tools is reshaping the buying experience. Online platforms that allow buyers to search inventory, compare prices, and complete transactions are becoming increasingly popular, giving consumers more power and flexibility than ever before. While these changes are disruptive to traditional dealership operations, they also represent an opportunity for the industry to evolve and meet the needs of modern buyers. The path forward is not without challenges, but it is also filled with potential. By prioritizing affordability, embracing innovation, and adapting to changing consumer demands, the automotive industry can emerge stronger and more resilient. The question is whether automakers are ready to make the bold moves necessary to secure their future, or whether they will continue down a path that alienates their customers and deepens the affordability crisis. One thing is certain, the road ahead will be anything but smooth, but with the right strategies and a renewed focus on value, the industry has a chance to rebuild trust and create a brighter future for car buyers and manufacturers alike.